We've gone from 26 million cars in 1930 to 258 million today, as of July 29th, 2015. We produced 2.46 million barrels in 1930, 8.7 today, and yet our inventories are matching November 1930 levels. That's frightening. That's jaw-dropping. Basically, the world, not just the United States, is technically in a deep, deep, deep recession / depression. And this is what QE does. This is what quantitative easing does.
The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit crushthestreet.com/gold.
Hello, everyone, and welcome into crushthestreet.com. Wow, I've been just watching the markets lately, and the markets are having a difficult time going up. I think that's to say the least. And I got a returning guest on the line. His name is Jim Comiskey, and you can find him on YouTube. You can find him under his name, Jim Comiskey. He was on our show about a month ago. He's been on the floor of the CME and the CBOT, and now he's with IFG Future Group as their senior market strategist, and he's got decades of experience in these markets, and he's going to shed some insight on what we're seeing today. So, Jim, thanks for joining me.
Absolutely, Kenneth. It's my pleasure as always. All right, I've been in the business since 1983, born and raised Chicago, and like Kenneth pointed out, I've been on the floors of the Chicago Mercantile Exchange and the Board of Trade, basically all that time. Up until around 2000, year 2000, I was dealing with mostly institutions, big banks. So I got a chance to look behind the curtain, of the drivers, okay, the whales in the industry. That industry being commodity futures, in essence, okay, what I call the big five: energies, currencies, indexes, metals, and yes, grains. Okay, and since 2000, I've been off the floor. I've been working in retail. Pleasure, truly a pleasure. Dealing with people that are somewhat lost at sea, as am I, admittedly, at times. But, I've been doing this a long time, and it's a passion of mine, obviously. It isn't a job. It truly is like that old commercial. It's an adventure.
We got the markets are going crazy, and the Bloomberg headline, I mean, with your experience, the Bloomberg headline is, we're $29 trillion. Companies' corporate debt is at $29 trillion, the highest in 12 years.
It gets worse.
Yeah.
But anyways, to answer your question on Trump, you know what? I'm a big student of history. And if you look back, and you can Google this, Ronald Reagan actually skipped the last Republican debate in Iowa when he was first running for president. I don't think it's going to backfire on Trump at all. I really don't. He's hitting a lot of buttons. But all right, here, let's dive in the pool. First of all, again, my name's Jim Comiskey. All right, you can reach me if you'd like to. If you're in the States, call me toll-free 800-786-4475. If you're outside the States, 312-384-1181. If you'd like to email me, please do so at jim.comiskey, COMISKEY, at ifgfutures.com. And as Kenneth mentioned, I do have a YouTube channel, Jim Comiskey Metals, and bam. I tend to put up what I call rants 3 to 4 times a week, and I primarily focus on geopolitical events and, in my humble opinion, how they're going to impact the price of precious metals. Okay, most notably gold and silver. But I have to start this off. This is one requirement here. There's a significant risk involved in trading futures and/or options on futures and/or options of futures. Trading may not be suitable for all investors. Investors should consider these risks and evaluate their suitability based on their financial conditions. Past performance is not indicative of future results. Let's rock and roll. Okay, this just came across the tapes. You know, a lot of times, Kenneth, you know, when I do interviews and stuff, and, you know, again, I've been doing this 34 years now in the markets and stuff, I get a direct question about what indicators do I look at. Okay? Now, let me give you, I'm gonna back up small here on you. Back in the late 80s, prior to cell phones and almost prior to computers, I used to, all we have are landline phones, and I used to call Alan Greenspan's secretary and basically drive her crazy, pick her brains, send her flowers, send her pizza, and she was a real sweetheart. And, you know, and what I wanted to know was, what indicators does Alan Greenspan look at when he first gets in the office? And what she said to me was scrap metal prices. Let's put that one in the toolkit, okay? Just Google it. The indicators I primarily look at, and what stuff we're going to talk about today, crude oil, okay? Do you know the war that's being fought in and out of OPEC on crude? The Baltic Dry Index, symbol BDIY on Bloomberg. It's currently at another all-time low.
As we speak, at the moment.
As we speak. That is 100% correct, Kenneth. I look at Caterpillar, okay, being the biggest manufacturer of earth-moving equipment. I look at Boeing, being one of the biggest manufacturers, obviously, of aircraft outside of Airbus. I look at Airbus. I look at railroads, okay. I look at Union Pacific. They're one of the biggest in the United States, and CSX. And there's another one that, you know, people that are on the other side of the curtain, guys that aren't, gentlemen, ladies, that aren't in the business, marinetraffic.com, okay? It's marinetraffic.com. It literally, it's an amazing site, tapped into Google Earth, and they basically have every existing tanker on the open seas, their location, their destination, et cetera, et cetera. It's a measure of global trade. Okay? If those tankers ain't moving, trade is declining big time. All right. So, by the way, this just came across the tapes. Freeport McMoran just got downgraded to junk by Moody's.
Wow.
Yeah, right. They're basically one of the biggest manufacturers of copper and gold. They also have a division, Freeport McMoran Oil and Gas, LLC, also downgraded to junk. So be a little careful with the miners here. There it is. Yesterday, EIA. And Kenneth, I want you to stop me at any time because, you know, I tend to be somewhat type A, although not with my wife and kids and people I work with. But if you want to interject, just stop me. Okay, well, I don't want to dominate the conversation.
No. It's fine. Cool. I just wanted to, maybe let's talk about some of these things. I mean, you went from the Baltic Dry Index to the Boeing. Absolutely. I mean, what are we seeing across the board with these indicators? Obviously, you mentioned Freeport McMoran getting downgraded. What are we seeing with some of these other industries that are indicating? What is it indicating to you at the moment?
Basically, the world, not just the United States, is technically in a deep recession / depression. All right. And this is what QE does. This is what quantitative easing does. This is what the Bank of Japan tried to perform a miracle when the Tokyo real estate bubble blew in the late 80s, early 90s. They immediately shot rates to zero in an effort to stimulate demand. That it doesn't work that way. Okay? What you've got to do is create wealth. And we'll get there. And here we go. Okay, the EIA, every Wednesday, the U.S. Energy Information Administration at 9:30 Central Time reports their the current inventory stockpiles of crude oil, unleaded gas, distillates, which really all you got to read about distillates is it's jet fuel, aircraft fuel, kerosene. And yesterday, my jaw hit the floor. All right, I'm reading from Reuters here, Thomson Reuters. Okay, U.S. crude stocks reached their highest levels on record last week. It is always a week behind, by the way. U.S. Midwest gas stocks reached their highest levels overall since 2010. U.S. crude inventories rose by 8.4 million barrels last week, climbing to 494.2 million barrels, the highest on record, according to the U.S. EIA. According to Jim Comiskey, the U.S. EIA didn't look back far enough. Okay? The last time crude oil inventories, and this is basically a WTF chart, were this low, or this high rather, okay, was in, wait for it, November of 1930.
Wow.
When Herbert Hoover was battling the Great Depression, okay? And this is factual. You can look it up. Basically, it's indicative of a severe fall-off in demand, drop-off in demand. Now, what I also want to point out with regards to, stating that, yes, crude inventory's highest level since 1930, how many cars existed? Actually, you got to look at registered motor vehicles in 1930. Kenneth, throw a dart. Come on, buddy. Throw a dart.
Well, I mean, we got 300 million people in the U.S.
Today, right?
Today, I mean, going back, I mean, it was less than half back then. So,
right. Okay. And
I would say 15 million cars. I don't know.
That's a great guess. 26 million registered motor vehicles in 1930. This is according to website Bryant.edu. And today, this is according to the USA Today, and I sourced it with 3 other sources. There's about 258 million cars on the road right now, registered light vehicles, versus 26 million in 1930. Okay, we produced 2.46 million barrels a day in 1930, the U.S., of crude. Today we produce 8.7 million barrels. Actually, this is 2014 CIA fact book. I couldn't get totally up to date because they're a little bit dodgy with their calculations. So in other words, you've gone from 26 million cars in 1930 to 258 million today, as of July 29th, 2015. We produced 2.46 million barrels in 1930, 8.7 today, and yet our inventories are matching November 1930 levels. That's frightening. That's jaw-dropping.
Yeah.
Yeah.
So what is that exactly saying? People aren't driving as much. Where is the demand exactly dropping off?
Great question. First of all, I want to point out North Sea Brent, which is another form, if you will, of crude. It's a little higher sulfur content, North Sea, north of, in the North Sea, between Norway and Scotland, has declined 76% since June 15th. It was at 117 a barrel. And right now she's at, I'll give you an updated quote. Right now she's at 34.22, down about 72% since June. Brent, crude oil. All right. It is my humble opinion that manufacturing activity is falling off the table due to the fact that you can no longer, the Fed and Obama and, Mario Draghi with the ECB, we're producing jobs, these jobs, and this is not an insult to bartenders and waiters, do not produce the amount of income that it takes to buy houses, to buy durable goods, goods that last more than 3 years, okay, automobile. Well, even if you're a renter, you're going to need an automobile, but washers, dryers, microwaves, the renters are going to use the microwaves. You get where I'm going.
Sure.
Okay? Well, the Baltic Dry Index, and I would ask your listeners to look this up because time is precious.
Yeah. We'll have it on the screen.
Oh, totally cool. It's a measure of global trade vis-a-vis cargo ships. Panamax, Cape Max, and Supermax. Just kind of look it up. Just hit a new all-time low I'm looking at it right now, Kenneth. It's 337 down 8 points. Once again, symbol for your listeners is BDIY. You can follow it on your own. Let's talk about railroads, shall we?
Sure, let's get right into it.
There you go. Okay, now, Union Pacific, largest U.S. railroad. Last Thursday, they reported operating earnings down 15% year over year, net income down 22%. The only category where revenues rose was automotive. Otherwise, revenues fell when they were shipping chemicals, down 7%, ag products down 12%, intermodal containers down 14%, industrial products down 23%, coal down 31%, which you would expect with Obama's war on coal. Okay, but it doesn't just go there. I mean, Sprint laid off 8% of its workforce last week. Walmart announced they're closing 269 stores. Okay, really? And yet the S&P continues to rally day after day after day. You think there's a little bit of New York Fed trading desk money behind this holding up this stock market?
Yeah, I mean that's the assumption. But coming from you, that's a serious credibility allegation. You know what I mean? You're a credible person to be able to say, hey, there's something going on behind the scenes, and you know that's to hear it from you is hard hitting.
Since since '06 when Bernanke came in, first thing he did was he instituted a policy where the Fed would pay member banks, basically 25 basis points on deposits that they hold with the Fed. All right, so suddenly they were incentivized to basically park deposits with the Fed in a risk-free trade should interest rates go to zero. Well, interest rates have been at zero since '08, okay? So where's the money going? That the Fed's balance sheet is slowly building and building and building, over $4.5 trillion as we speak. Well, it's going a risk-free trade. The 5 biggest banks in the country, just pouring that money into indexes. A risk-free trade. Caterpillar, okay, they announced today their earnings.
Hold on, before I want to reemphasize that point because you know that is really people really haven't talked about it in the way that you just mentioned it right there. You're talking about the risk-free trade. You know, the money that the Federal Reserve has been printing is building up. We're seeing the inflation in the asset prices, in indexes, in real estate, but it hasn't been circulating into the economy because the banks are making that risk-free trade, and it's going into the stock market. And before we get into Caterpillar, I got to ask you: are we going to see that money, those excess reserves, go into the hands of the consumer, and what will happen if that money does circulate through the economy? I mean, are we going to see massive inflation if that does actually happen, or will it even happen? Do you see that happening?
Before you see massive inflation in every cycle going back to the Sumerians, okay, you see deflation. Then you see the sovereign, okay, whatever ruling power, be it a central bank, kingship, whatever, try and stimulate the economy, and invariably they overstimulate the economy. So, again, to recap, you're going to see a significant period of deflation in commodities, and then you're going to see a major spike in inflation, because they're all of a sudden, you know, companies are going to realize, hey, we have a shortage of workers here, we're starting to get a pickup in the economy, blah, 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 and that is when you're going to see the metals, particularly gold. I mean, it's been in a bear market since like 2011, to be honest, but that's when you're going to see the metals take off and the dollar tank. And I won't even go into the BRICS, you know, trying to usurp the dollar with the yuan and the ruble, replacing it in terms of a global trade, fiat currency. That's for another That's for another webinar, okay?
So it's not going to be the velocity of money you're saying that's going to cause hyperinflation. It'll just be people recognizing that the dollar doesn't have intrinsic value and they will dump it?
Correct. But you hit on a good salient point there, and I did say no, and that was just almost instinctive. Yes, you will see an increase in velocity of money because all of a sudden you're going to see a major increase in the amount of dollars that are circulating. Okay? And there's your inflationary effect, and there's your bearish impact on the dollar, and there's your bullish impact on the metals.
And the banks will likely continue to do what they're doing, which is their risk-free trade in the markets.
But now think about this. They're borrowing at 0.25%. Well, the Fed raised rates to 0.25%, in December. So that risk-free trade is no longer risk-free.
Right.
That's why we're starting to see these crazy moves in everything. Indexes, crude oil, metals, energies. Well, yeah, crude oil. I mean, it's an ancillary effect. It even trickles down to like the grains because of the value of the dollar, right? Mm-hmm. Now, you cool, or can I continue?
I'm very happy, Jim.
Okay.
Yeah, go ahead and continue with
Cool.
Caterpillar, and we'll get your thoughts on that.
All right, Cat announced this morning. All right, their Q4 sales down 23% to $11 billion. Okay, missed already deeply cut estimates 11.4, and that led to wait for this, 111% collapse in operating profit from a $1.1 billion profit to a $114 million loss year on year. Okay. This is, the biggest earth mover, and I'm going to quote their CEO, whose name escapes me right now, but this is a quote, and this is courtesy of Zero Hedge, by the way. This past year was a difficult one for many of our industries and customers. Sales and revenues from 2015 were nearly 15% lower than 2014 and 29% off the 2013 peak. The two most significant reasons for the decline from 2014 were weakening economic growth and substantially lower commodity prices. A lot of this has to do with, yes, China. China is basically, their number one export these days is deflation. They're selling steel, aluminum, coal on the open markets internationally at way below production costs because they want to try and maintain market share. They want to try and keep their factories open. They want to try and keep 1.3 billion people happy with jobs. But what they're doing is they're creating deflation worldwide. And as you know, you follow the tapes, Kenneth, every central bank wants to see inflation. Well, why would they want to see inflation? Because it spurs and is indicative of increased consumer demand. Mm-hmm. Okay? And that's not going to happen as long as China is where it is. And China is going to be there, in my humble opinion, for a long time. Mm-hmm. Boeing. Yes, Boeing. Now, you got to look at Boeing's earnings and stuff, and they reported yesterday with a bit of a grain of salt because a lot of sovereigns, a lot of countries will announce huge orders for aircraft and then suddenly cancel them. But, okay, I'll just go here. And this is courtesy of Bloomberg. The Boeing Q4 earnings, they beat expectations, but they were sharply lowered in recent months. Of $1.27 a share, they dropped 31% compared to Q4 last year, driven by a 4% drop in the top line, leading to a substantial decline in gross profit from $3.8 billion to $2.9 billion, a whopping 38% plunge in operating cash flow to $3.1 billion. Now, you heard what I just said about Caterpillar.
Right.
You heard what I just said about Boeing. Okay? They lowered their forward guidance tremendously. Okay? By the way, going back to Cat, they have basically, their sales have suffered for 37 months in a row. That's over 3 years. That's a first in the history of Caterpillar, which I'm going off the cuff here, but I believe they've been around since 1919.
Wow.
Okay? Yeah. bankruptcies in the oil markets. Sand Ridge. Okay, many of you might not be familiar with Sand Ridge, but they are the second largest Canadian shale oil producer, and they just filed for Chapter 11. Let me state this. This was last week. This was on the 25th. Okay, they basically filed for, well, they're $4 billion in debt, and they're going BK. They're going bankrupt. All right. This is the second largest bankruptcy in shale producers in the last 2 years, behind only Samson Resources with its $4.3 billion BK, ahead of both Sabin Oil and Quicksilver. All in all, 42 shale producers have already went bankrupt in calendar year 2015. I'm not boring you, am I, dude?
No, Jim, this is very indicative of the economy. So what exactly is this telling you about the direction of the economy, and as far as what you do in terms of making money with this trade?
Cool. Let's talk specifics. All right. Once a week, okay. They vary it up, but on Wednesday afternoon, Thursday afternoon, it's usually on Thursday afternoon at 3:30 Central Time, the St. Louis Fed releases their information about where the Fed's balance sheet currently stands. Okay, St. Louis Fed. You can actually Google FRED, F-R-E-D, and you can get it. Basically when the market gets it, all you have to, in terms of equities, all you have to do is look at where the Fed's balance sheet is, and that's where the equities are going to be, up or down. And now that the Fed, but they know they made a mistake. They realized they made a mistake raising rates. Personally, Kenneth, they never should have lowered rates, not to zero. In 08, they should have let AIG fail. They should have let Merrill fail. They should have let Bank of America go under. They let IndyMac go down. They let Lehman Brothers go down. And I could go on and on and on. If they had left rates at like 3%, and that's the purest and coldest example of capitalism, in my humble opinion, at its finest, is when risk takers are allowed to fail, and they're allowed to profit, but they shouldn't be feeding off the taxpayer's dime, which is why the markets have been so, the collegiate term here, they've been so screwed up since 08, 07. Right? We'd be at 5% GDP, we'd have 3% unemployment, and so anyways, just look at the Fed's balance sheet on a weekly basis, and that's where the indexes are going to be, up or down. In terms of crude oil, right? Now there's a big war going on. There was rumors yesterday. By the way, April crude is currently. Let me quote your listeners up here. April crude is currently at 34.84, up $1.08. Okay, now March is about to roll over to April, so if anybody's trading March crude right now, you might want to call your broker, or call me. All right. All right, so there were rumors yesterday that Russia was going to, a non-OPEC producer, one of the biggest in the world. We pretty much vie with Russia, Saudi Arabia, and the U.S. now as biggest producer of crude oil. We just kind of bounce back and forth. But Russia said that they were open, it was a headline rather, on Reuters. They were open to discussions with OPEC on perhaps curbing production. And those rumors were flatly denied. Having said that, crude's up $1. Okay, Iran is ready to flood the market with an estimated 3 to 4 million barrels a day. Iraq is ramping up big, and despite all the turmoil in Iraq, they're still the number 2 producer in OPEC, and they're going great guns. So, okay, there's your energies, there's your equities, the currencies. We're basically bouncing headline to headline in the Forex markets, which, by the way, are by far and away the biggest markets on earth. Basically, you got a situation, and it's extremely rare, Kenneth, when one central bank, U.S. Fed, goes counter trend to basically the other, say, big three, the European Central Bank, the Bank of Japan, and the People's Bank of China. You got the Fed trying to raise rates, pretending like everything's cool, and the other central banks are like, oh my God, we're going to have to go negative on interest rates. And money chases yield on a global basis. Higher interest rates, if they're in Australia, if they're in Canada, if they're in Japan, if they're in Mexico, if they're in the UK, if they're in Germany, money chases yield, right? So if the Fed's raising rates, that makes for a stronger dollar, weaker commodities, okay? But it also puts major pressure on Europe, Asia, okay? By, in essence, weakening their currency significantly, good for their exporters. However, it isn't good, on a monetary basis, because strong currency, not this wealth effect stock market BS, a strong currency is indicative of a strong economy. And for the Fed to have done what they did was just, almost, I'll say criminal, but obviously it wasn't. It was just bad timing. By the way, November 30th of 1930, crude oil inventories, highest since they've been like last week in the States. You know what the Fed did in 1932?
What did the Fed do?
They raised interest rates. History repeats itself, okay? Therefore, in my own, I got a classical education. I ain't the smartest, the sharpest pencil in the box, but I kind of know my stuff. But every single day I learn new stuff. Can I read you, well, first of all, do you have any questions on what I just said? And then I want to read you one final thing, and I'll let you guys go. How long are we, by the way, right now?
We're right about the 32-minute mark. So let's get that, your final thoughts on that. What you want to read?
Okay. Yes, this is from a buddy of mine. I'm going to cite his name, Jim Erb. He won't mind. Jimmy, this is to you, buddy. The Arctic Ocean is warming up. And this is kind of tongue-in-cheek, but just bear with me, okay, Kenneth? It dovetails nicely with what we've been talking about. The Arctic Ocean is warming up. Icebergs are growing scarcer. And in some places, the seals are finding the water too hot. According to a report to the Commerce Department yesterday from Consulate at Bergen, Norway, reports from fishermen, seal hunters, and explorers all point to a radical change in climate conditions and unheard of temperatures in the Arctic. Exploration expeditions report scarcely any ice has been met as far north as 81 degrees, 29 minutes. Soundings to a depth of 3,100 meters showed the Gulf Stream still very warm. Great masses of ice have been replaced by moraines of earth and stones, the report continued, while at many points well-known glaciers have entirely disappeared. Very few seals and no whitefish are found in the eastern Arctic, while vast shoals of herring and smelts, which have never before ventured so far north, are being encountered in the old seal fishing grounds. Within a few years, it's predicted that due to the ice melt, the sea will rise and make most coastal cities uninhabitable. This report was put out by the Associated Press and published in the Washington Post November 2nd, 1922, 93 years ago. Don't listen and don't believe everything you hear. Look into it yourself. Okay? Rick Santelli, my mentor in the business, literally, Drexel Burnham Lambert, 1983. He taught me that. And Rick's one of the finest men in the business. I'm really surprised he's with the Bubble Building Network that he's currently with. That network, which will remain unnamed, but November 2nd, 1922, Washington Post.
Wow.
We're all going to die. All right, buddy. That's pretty much all I got. But you go ahead.
So, Jim, you left us with that. What are your thoughts then? Just last 30 seconds. What are your thoughts then with what we are going to see here in 2016, and just kind of your mindset for all of this economic information that you shared with us. I mean, how do we absorb this information?
All right, I'm going to throw a big dart, okay? Because you just threw one. You prefaced it by 2016. That's a long time, okay? I think that, all right, write this down and we'll talk in a year, okay? I think you're going to see the S&P down around 1580, 1600. And the SPU currently, one second, is at 1887, up 12 points. I think you're going to see crude oil at $18, currently at 35. I think you're going to see the greenback at 101. I think you'll see the euro down at par versus the greenback, okay? And I think you're going to see the T-bond basically at an unprecedented 167, 168 handle. It's currently at 160, which means the market is going to lower rates for the Fed because the Fed's going to have to back off on that 25 basis point hike now that they've painted themselves in a reduced demand corner for consumer goods. Okay, they have major issues. They know it. But again, if there's really two ways, in my humble opinion, to protect yourself from what I view as a potential flash crash in the indexes. And 1580, yeah, that's my dart, but we could go lower. Metals, just start stacking them. You know, but if you're listening to me and you're taking my advice on that, do not put more than 20% of your investable net worth, your liquid net worth, into the metals. Just do that, throw them in a drawer. Hopefully you don't make a ton of money on the gold and silver, but what you're doing is you're preserving the wealth that you've already created for yourself in your working career. Number two, real estate. Location, location, location. Be smart about it, but I think that's the only two places, Kenneth, to really protect your wealth, because I think we're going to have a blow-off here, and it's going to be bloody, it's going to be violent, and the world's smartest people, okay, the central bankers amongst us, are going to be completely clueless as to what they've engineered. Works real good on a Princeton faculty lounge blackboard. In real life, not so good. Mario Draghi last week, and I'll leave you with this unless you have other questions. The EC met last Thursday, as they do every other Thursday. And the reporter asked him a question that wasn't so softball, because most of them are. He said, hey, I'm with Financial Times, blah, 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 I forget his name. What will the impact of negative interest rates be on the capital markets, okay, credit markets, interest rates, cost of money, and equities? And Mario Draghi, ex-Goldman Sachs, managing director, ex-Vampire Squid, current president of the European Central Bank, responded to this reporter by saying that question would be better answered by a market analyst. I'm not in a position to answer it. Really?
Yeah.
Okay.
The head guy. The guy in charge.
Inspires confidence. Oh, boy, you betcha. Oh, my God. That's a quote. Yeah. All right, but that's all I got. Unless you got any other questions or anything.
That'll be it for today, Jim. I really appreciate you coming on. Everyone, that's
Absolutely.
Jim Comiskey with IFG Futures Group. Jim, thanks so much for coming on the show with me today.
Absolutely, Kenneth. As always, buddy. You know, it's great talking to you. It's great coming on. It's great. You know, after all these years in the biz, it's just gratifying to me to be able to give back a little bit of well-earned knowledge and knowledge to be well-earned in the future to your listeners. I mean, we're all in this together, and that's the way I truly feel.